Today I would like to analyze Church Dwight, one of the largest personal care companies in the world. The stock price is down around 25% in this year, so we're going to take a look at the financials to find out if it's a good buy right now. The first thing we can recognize is the market cap of 20.19 billion US dollar. This makes Church Dwight the 13th largest consumer good company in the world by the market cap. We also have a dividend yield of around 1.4%, which we can see here had a good dividend growth rate in the last 10 years. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and a declining business. So in 2020, the revenue was around 4.9 billion US dollar. This was a good growth, around 12% from 2019, so probably related to COVID. Then in 2021, we had a decent growth around 6%. In 2022, a decent growth around 3.6%. In 2023, a good growth around 9%. And then in 2024, again, a decent growth around 4%. So overall, in the last 5 years, I would say we had a decent growth. So check here, and we like to see that. The next thing we're looking for is the free cash flow growth in the last 5 years. The free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2020, we had a free cash flow of 0.98 billion US dollar. This was a very good growth rate, around 12% from 2019. In 2021, we had a decline around 2%. In 2022, a strong decline around 19%. So this is something we don't like to see. Then in 2023, we had a comeback with a very good growth rate around 14%. In 2024, a very good growth rate around 21%. And then in 2025, a very good growth rate around 17%. So overall, in the last 5 years, I would say we had a good free cash flow growth. So the check here, and we also like to see that. The next thing we're looking for is a free cash flow yield over 4%. This can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So we're going to take the free cash flow from 2025. This is around 1.02 billion. Then we're going to divide it with the current market cap. The current market cap is around 20.19 billion. And then we're going to get the free cash flow yield for 2025. So the number we're going to get would be around 5.05%. I think that's a good free cash flow yield. It's over the 4% that we're looking for. So the check here. We can also take a look at the free cash flow assumptions. In 2026, around 1.036 billion, and in 2028, around 1.1 billion. So let's assume for 2028 this number, 1.1 billion. We're going to divide it with the current market cap, 20.19 billion. And then we're going to get a different free cash flow yield for 2028. So the number we're going to get would be around 5.44. And I think that's a very good free cash flow yield as well for 2028. It would be a check here. And I think that's something we like to see. The next thing we're looking for is a debt to free cash flow ratio under 5. This means the company can repay the debt with a free cash flow in under 5 years. A very important number, because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So first we're going to take a look at the long-term debt. We can see here around 2.2 billion. Then we're going to add the short-term debt as well, but we not have a short-term debt here. So we're just going to divide this number with the current free cash flow. This is around 1.02 billion. And then we're going to get the ratio that we're looking for. So the number we're going to get is around 2.15. And I think that's a good number. It means in a little bit over 2 years, we can repay the debt with the free cash flow. So the check here, and we like to see that. We can also take a look at the cash on hand, how much money this company has in the bank, around 0.31 billion. I think that's a decent number. So overall, I think this company has a good balance sheet. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So first we're going to calculate the enterprise valuation. That's the current market cap, 20.19 billion. We're going to add the debt as well, 2.2 billion, minus the cash, 0.31 billion. And then we're going to get the enterprise valuation, so how much the whole company is worth. So the number we're going to get would be around 22.08 billion. So now we're going to divide this number with the current free cash flow, 1.02 billion. And then we're going to get the ratio that we're looking for, and that's around 21.64. I think that's a decent number actually. It's under the 25 that we're looking for, so the check here. We can also calculate this number for 2028 with our free cash flow assumptions of 1.1 billion. Then we're going to get a different number. So the number we're going to get would be around 20.07. And I think that's a decent valuation. To me, it's not an extreme undervaluation, but it's also a check here for 2028, so we like to see that. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that, especially if we think the company is undervalued. So we're going to see here, some years they did buy back a lot of their shares. In 2021, around 1.53%. But in some years, we can also see an increase in the shares outstanding, 2023 and 2024 as well. But overall, I would say they're buying back their own shares. So this is something we like to see because I think they can also afford it. They have a good balance sheet. So it's a check here. Can the Church Dwight stock be a good buy right now? The stock price is down around 25% in this year. So let's start with a positive about this company. I think they had a decent revenue growth in the last 5 years. It was not very high, but it also was quite okay. They also had a good free cash flow growth, so this is something we really like to see. The balance sheet is also looking quite good at the moment, so we have a low amount of debt and a good amount of cash on hand. The free cash flow yield of around 5.05% is also quite good, and in 2027 with our free cash flow assumption, it could be around 5.44%, which would look even better. The enterprise valuation to free cash flow ratio around 21.64 is also quite good. We like to see that number under 25. And in 2027 with our free cash flow assumption, this number could be around 20.07, which would look even better. So overall, I think it's a decent valuation at the moment. In my opinion, it's not an extreme undervaluation. The dividend yield of around 1.4% is not very high, so the growth rate was quite okay, but I think this dividend is not very attractive. They also not have many shares buyback, so they're not buying back a lot of their shares, and this cannot really help the stock price at the moment. So overall, I think it's an interesting company. The valuation is quite okay, but I think it's not an extreme undervaluation, and I wouldn't buy the stock at the moment. If you found this video helpful, don't forget to like and comment and subscribe for more content.